Hello, everyone. Today we're going deep on the lethal mechanics of crypto leverage. Follow along with the Bitcoin daily chart on screen, Binance, Bitcoin USDT 1D. Leverage means trading with borrowed money. $10,000 controlling $100,000 of exposure, a bit like taking out a student loan from the bank. But here's the difference. A student loan gets repaid slowly over 4 years. With leverage, a move of just 10% against you can wipe out your entire collateral overnight. By the end of this lesson, you'll understand why one trader's loss can automatically become another trader's gain, and why that matters for your own risk. On the Bitcoin daily chart, Binance, Bitcoin USDT 1D. Compare spot trading to perpetual futures. With spot, if you have $100, you can only buy $100 worth of Bitcoin. What happens when you pick 10 times leverage on a perpetual futures contract? That same $100 now moves as if you had 1,000. The exchange lends you the other 900. Think of it like putting $20,000 down on a $200,000 house, a small deposit controlling a much larger asset. You control a $1,000 position with just $100 in collateral. That's where the liquidation spiral begins. 로게터 비트코인 퍼페추얼 차트 온 스크린, BINC, 비트코인 USDT P1D. This is where we explain the liquidation price. The liquidation price is the level where the exchange forcibly closes your position, like a bank foreclosing when your home equity falls below the loan balance. 이그젬플, 비트코인 at $80,000, 10 곱하기 사인 롱, $8,000 in collateral. Liquidation price equals 80,000 times 1 minus 1/10 equals $72,000. Drop to that level and your margin is gone. The position is auto-closed. If price keeps falling, you can owe money a negative balance. Beginners should set a stop loss at least 3 to 5% above the liquidation price. In high volatility, give yourself even more room. It doesn't end there. When you get liquidated, the exchange can take a loss too. Where does that shortfall come from? First, the exchange taps its insurance fund. But that fund has limits. In May 2021, when Bitcoin crashed from $65,000 to $30,000, hundreds of thousands of leveraged positions were liquidated at once, draining major exchanges' insurance funds in just hours. When the insurance fund isn't enough, the remaining loss gets pulled automatically from profitable traders on the same venue. This is called funding settlement or socialized loss. If you made money on a long, part of that profit may quietly come from someone else's liquidation loss. That's systemic risk, crypto futures as a zero-sum game. One big winner is often built on many losers' pain. On the Ethereum Perpetual chart, Binance, Ethereum USDT P1D, let's cover 2 margin modes, isolated and cross. Isolated margin. You assign collateral to each position separately. Out of a $10,000 balance, you put $1,000 into Bitcoin and leave the rest untouched. If that position gets liquidated, you only lose that $1,000. Cross margin. All positions share one pool of collateral, like one checking account backing every trade. A loss in one position can threaten your entire balance. Beginners should always use isolated margin. One mistake won't wipe the whole account. Stopping a Bitcoin stop out from cascading into your Ethereum position is survival rule number 1. 온 더 비트코인 퍼페추얼 차트, BINC, 비트코인 P1D 되어진 후 expiry date on this contract. So, who delivers the underlying spot asset? Nobody. The exchange uses funding instead. Funding is an interest-like payment between traders. In a bull market, longs pay shorts. In a bear market, it flips. Funding is settled every 8 hours.
typically somewhere between 0.01% and 0.1%.
In a strong rally, the kind you see when the Nasdaq is ripping and the Fed is on hold, rates can run much higher. Example, $100,000 notional at 10 times long, funding at 0.02%. Every 8 hours you bleed about $200. 3 times a day equals 600. A month adds up to 18,000, annualized, over 200,000 in drag. Price has to rise enough to beat this hidden cost, not just go up. Let's wrap up. Study the Bitcoin weekly chart, Binance, Bitcoin USDT 1W, and notice how a single sharp drop can liquidate thousands of traders in minutes. Leverage is borrowed money, and liquidation is the forced exit that collects the bill. When losses get large enough, exchange rules can spread that burden across other participants through socialized loss. The system is neutral on paper, but for you it's unpredictable risk. If you must use leverage, follow 4 survival rules. 1. Isolated margin only. 1 bad position shouldn't drain the whole account. 2. Risk no more than 1 to 2% of total capital per trade. 3. Place stops at least 3 to 5% above liquidation, wider in volatile markets. 4. Tally cumulative funding costs once a week and write them down. Most important, crypto is 2 to 3 times more volatile than the S&P 500. Assume your read of the chart will be wrong sometimes. The vast majority of leveraged traders eventually get liquidated. Survival comes before profit. Warning, this lesson is for education only, not a recommendation to trade. Every decision and every loss is yours alone.